Hello and welcome to gotstockz. Today is Tuesday, March 4th, 2025. We are going to sell put options on Apple stock today without using the charts. We're only going to use the option platform. This is the Thinkorswim platform. I learned this strategy from Tom Snosnoff with Tasty Trade. He's been in the business for over 40 years. He's one of the developers and designers of Thinkorswim and also the developer and designer of Tasty Trade. So he is one that can be trusted. This is going to help minimize your risk, maximize your profits to help build your perfect portfolio. I respect and appreciate your time, so let's get right into it. We are going to go to the options platform. The first thing that we want to look at is this column over here is our expected move range. This column over here is our implied volatility. We are also going to be looking at, this is our expiration of contract. What we want to do is we're going to go out 30 to 45 days. So let's pick a date of April 11th. Now, when trading options, you want to pick companies that you're okay with owning, because if you're assigned these shares, you have to be okay with owning the company. I'm okay with owning Apple. I own Apple, and I don't mind owning some more if I get assigned. But meanwhile, I'm going to try to collect some money implementing this strategy. So what we're looking at is the expected move range of 19.48, and our expiration period is April 11th, 2025. The numbers we want to pay attention to is the stock is currently trading at 237.44. 237.44. 42. Calculate. 218.02 is going to be our strike price range. We could either look at a 215 or a 220 strike price with the expiring on April 11th of 2025. This is our strike column, our bid, ask. This is the delta column, return on risk. This is the volume of contracts. This is the open interest. This right here is our implied volatility, which is currently at 31.47. And this is our expected move range. We're looking at 215 or the 220. So the 215 is going to give us a delta of 15. And the 220 is going to give us a delta of 20. So a delta of 15 means that there's a 15% chance of being assigned these stocks by that expiration date. So there's an 85% chance of the options contract expiring worthless. You just collected the premium, and then you just keep doing this over and over. These deltas are considered on the low end of the range. This is going to be a high probability of profit, although it's going to be a low percentage ratio of profit of only 1% or 1.34%. I'm going to go to the 220. So we're actually selling a put contract. So we click on this. This opens up this page, and then we are going to hit confirm. And this opens up this page, which shows us our break even is 217.10. Our maximum profit is 290. Now it shows a maximum loss of 21,710. They have to show you that if the stock price goes to zero, that's what you're going to lose. But is that going to happen with Apple? Probably not. There's no guarantees. Probably not. That's why they recommend to only pick stocks that you're willing to own and pick great companies. If you start buying skeptical stocks, well, you can lose all your money. And we don't want to do that. We want to make money. We're going to go to the charts, open that up, and this shows that we have a position set for one put contract with a strike price of 220. So the stock price is going to have to retrace from here all the way down to there by April 11th. And if that happens, then we will be assigned. Then you're buying the stock at a very discounted price. I hope this was helpful. Thank you for tuning in. And always remember to do your due diligence. The market's very risky. Dot your I's, cross your T's, and don't forget the Z. God bless and happy investing.